A lot of people get confused about this, and the reason why is because it's confusing. It takes a while to wrap your head around all this because most people don't have access to two 401ks. They don't make enough money to make contributions to two 401ks anyway. And a lot of even advisors and accountants don't realize you can have more than one 401k. So let's go over the rules about multiple 401ks to start with, and then specifically talk about mega backdoor Roth IRA contributions. Here's the rules. You can make one employee contribution no matter how many 401ks you have access to. Okay, that is a total for 2022 of $20,500. For 2023, that's going up to $22,500. Okay, if you have two 401ks you have access to, you can split it. You can put some into Roth if the plan allows it. You can put some into tax deferred. You can put it all in Roth, all in tax deferred, whatever you want. All right, as long as you make $20,500, you can put it all into a 401k. All right. But you cannot, if you have more than one 401k, you cannot put $20,500 into one, then put $20,500 into a second, and $20,500 into a third. You only get one employee contribution. Okay, that's rule number one. Rule number two is that each 401k you have access to, that means each 401k you have at an unrelated employer, can have a total contribution of $61,000. This is for somebody under 50, just like the other amount was for those under 50. Once you're 50 plus, there's some catch-up contributions, both for the employee and the total contribution. But if you're under 50, you can put in $61,000 total, or a total of $61,000 can be put into each 401k that you have. That goes up to $66,000 for 2023. So there's obviously a big difference between $20,500 and $61,000. There's a big gap there. That gap can be made up with two kinds of contributions. Okay? It cannot be made up with employee contributions. We already talked about those. It can be made up with employer contributions. And depending on the employer and the plan, that can be a small amount, it can be zero, or it can be the whole rest of the amount. It could be a total of $40,500 if your employer loves you. If they don't love you, it might be nothing. Most people, it's something in between. For a typical doc, it might be, $5,000 or $10,000 as kind of an employee match, might be what they give you. If they're generous, maybe they give you $20,000 or $30,000 more dollars, but very few will actually take you all the way up to the $61,000 limit. The other type of contribution that can be made into that account beyond employer contributions are what are called after-tax employee contributions. Okay, so these are not the typical Roth or tax-deferred contributions you make for the first $20,500. They are different. So there's three kinds of contributions here. And you can make those if your plan allows them. Many plans do not, but if your plan does, you can make that sort of a contribution into the plan. And let's say you put in $20,500. Let's say your employer put in $10,000. So that leaves you $30,500 that you could put in as an after-tax contribution. Now, an after-tax contribution is not awesome. It's good, I guess. You get some asset protection from it. You get tax-protected growth on it. But when the earnings on that come out, you're going to pay taxes on them at your ordinary income tax rates. And you're not getting a tax deduction when you put the money in. So by itself, after tax, not awesome. If it's there for a long time, that tax-protected growth can overcome the fact that you're paying ordinary income tax rates on withdrawals. But if it's a short time period, you're probably better off in a taxable account. You're getting no tax break for either one up front, and the taxable account, the earnings come out at long-term capital gains rates and at qualified dividends rates, assuming you invest wisely there. However, if there is another feature that the 401k offers, this can be a really great move. And that feature is essentially an in-service Roth conversion or an in-service withdrawal, where you can withdraw it to an IRA and convert that to a Roth IRA. This process, making after-tax contributions into your 401k, and subsequently converting them to a Roth IRA or within the plan into a Roth 401k is a great move. This allows you to make additional Roth contributions that you wouldn't be able to make if the plan did not allow this. For example, if there were, a couple and each of them had access to this, and they're doing backdoor Roth IRAs, and they're doing this mega backdoor Roth IRA, and they're making Roth 401k contributions for their employee contribution. I mean, in 2022, a couple under 50 put into Roth $134,000 into Roth accounts in a single year, never to be taxed again. So it can be pretty powerful. Now, it's not necessarily a better move if you can put in all kinds of tax-deferred money in your peak earnings years. That's usually the right move. But if you can't do that, or for some reason you're a super saver and you just want to do more in Roth, it gives you another option. So this brings us to where the rubber meets the road, the typical situation that doctors have. Typical doctors got this W-2 job at the hospital or at the clinic or in the physician practice or as a partner or whatever, and there's one 401k there. That doctor uses the employee contribution there, gets some sort of match, some employer dollars there, whatever, and then does some moonlighting, has some 1099 income per call or whatever. And that money, he starts wondering, well, what can I do with that? Well, you open a solo 401k. You've already burned your employee contribution, so you can't use that. The easy thing to do, and the thing that's easily allowed at any old solo 401k that you open at Vanguard or Fidelity or Schwab or whatever, is to just do the employer contribution, which is basically 20% of your net self-employment earnings, net of the employer half of payroll taxes, and of course all business expenses. That's the easy thing to do. So 20%, you make $50,000 is 1099, you put $10,000 into the solo 401k. However, if you get a solo 401k that allows these two steps that are required for the mega backdoor Roth IRA process, you could put in even more. Let's say you made $50,000 at this 1099 job, and you wanted to put it into Roth, and you went out and got kind of a customized solo 401k. And you can go to the White Coat Investor website, and you can go under our recommended drop-down menu. You go to retirement accounts and HSAs, and there are companies that can set these up for you. And you can set it up so that you get a solo 401k that allows a mega backdoor Roth IRA. If you do that, you could put pretty much all of that $50,000 you made as an independent contractor, as a 1099, as a moonlighter, into a mega backdoor Roth IRA. So what's the total limit? Well, in 2022, it's $61,000. In 2023, it's $66,000. So if you make $100,000, you can't put $100,000 in there, but you could put, $66,000 in there next year. So that's certainly way better than a kick in the teeth. And a lot of people look at that and go, well, I would much rather put in, $66,000 into Roth than put $20,000 into, tax deferred account. So they do that. And as long as you get a solo 401k that allows that, you can do it. But don't expect it from the cookie cutter off the shelf 401k that you get at Vanguard or Fidelity. I don't think they allow that yet, but hopefully soon.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.